Welcome to Breaking News to Trading Moves.
Glad to be here for this one.
Right now, there is a clear capital rotation happening on Wall Street, and it is exposing a pretty stark divide in the financial sector.
Yeah, you can really see a very distinct split forming right in front of us.
Exactly. And Citigroup just posted its highest quarterly revenue in a decade. So that single headline really gives us a perfect roadmap. Today, we are tracking exactly where the smart money is fleeing to and, where it is running away from.
Right, because our mission today is to look directly at that headline and figure out exactly which financial stocks are benefiting from this environment of elevated trading and deal making. And we also need to see which ones are lagging behind.
Yeah, we want to bring you, the listener, right into the middle of this. We are taking the specific metrics from that earnings beat and applying them to the broader market.
I mean, when one division of a major bank posts a 39% gain, it tells you exactly what kind of market environment we are operating in right now.
It really does. So let us get right into the facts. Citigroup recently posted a remarkably strong earnings beat. Total markets revenue rose 19%.
Which is a really solid number on its own.
It is. But then equity markets fees saw a 39% jump, and the banking division revenue increased 15%. Because of these robust numbers, Citi shares are shot up to their highest level since November 2008.
Wow. Since 2008, that is a massive data point.
Yeah, it is. And those numbers from Citi point to a very clear driver of revenue, and that is trading activity. It is not necessarily long-term investing or traditional lending that is moving the needle here.
No, not at all. It is the sheer volume of buying and selling.
Right. And that leads us right into our first group of market winners, which would be the diversified universal banks.
The data points directly to them. Large money center banks are just benefiting so much from elevated trading activity, strong client flow, and highly active capital market.
And it is not just Citi, right?
Exactly. JPMorgan and Wells Fargo also posted numbers that beat first quarter estimates. At the time of this data, Bank of America was still due to report, but the numbers from Citi, JPMorgan, and Wells Fargo automatically lift sentiment across the entire big bank group.
Yeah, because investors see these earnings beats and recognize that trading, underwriting, and advisory conditions remain really supportive across the board.
They do. It is a very favorable setup for them.
So to put some exact names to this for you, the specific stock tickers for these beneficiaries are C for Citigroup, JPM for JPMorgan Chase, and BAC for Bank of America.
And, to make sense of how this operates, you can think of a diversified bank like a massive department store.
Oh, I like that analogy, like different floors doing different things.
Exactly. If the retail lending department on the ground floor is quiet, like maybe fewer people are looking for mortgages or auto loans right now, the trading and investment banking departments on the upper floors are currently chaotic.
Right. Chaotic, but highly profitable.
Yes. Busy enough to keep the overall business making a lot of money.
But I want to take you and the listener behind the curtain here for a second. Mechanically, what is actually happening on the trading floor when the market is swinging wildly? Like, how does volatility translate directly into cash for these banks?
Well, it comes down to strict institutional mandates. It is all about how professional trades are executed. Volatility means asset prices are moving rapidly.
And when prices move, institutional clients cannot just ignore it.
No, they cannot just sit on their hands. Clients like pension funds, university endowments, and large hedge funds have incredibly strict risk parameters dictated by their bylaws.
Okay, so give me an example of how that works in practice.
Sure. Let us say a pension fund is legally required to hold a portfolio that is 60% stocks and 40% bonds.
The classic 60-40 split.
Exactly. If the stock market suddenly spikes, the value of their equities goes up, and suddenly their portfolio is, say, 65% stocks and 35% bonds.
So they are out of balance.
Right. They are now out of compliance. They are legally obligated to rebalance. They have to sell stocks and buy bonds to get back to that 60-40 target.
And every single time they do that, they have to execute a trade?
Yes. And these diversified banks sit directly in the middle of all that required activity. The bank facilitates the transaction. They act as the market maker.
Right. And that brings up a term we hear a lot but rarely define, which is the bid-ask spread. This is essentially how the bank monetizes that constant rebalancing, correct?
Exactly. Let us break down the bid-ask spread so it makes complete sense.
Here.
Imagine you want to sell a share of stock. The bank says, I will buy that from you for $9.99.
Okay.
A millisecond later, a hedge fund comes along wanting to buy that exact same stock. The bank says, I will sell it to you for $10.
So the bank just made one single penny on that transaction.
Right. It sounds microscopic.
Yeah.
But when you have elevated volatility and institutions are rapidly repositioning billions of dollars, that single penny is multiplied by millions of shares, thousands of times a day.
Wow. So as long as volatility stays elevated, these businesses capture those microscopic fees in massive volume.
Precisely. They just sit there and collect.
That perfectly bridges us into a closely related subset, which is the capital markets and trading heavy financials. Going back to the core data, the strongest part of Citi's results was market-related revenue.
Yeah, the numbers there were really striking.
We saw fixed income trading rise 13%, happening right alongside that massive 39% jump in equity fees. Commodities performance was also remarkably strong.
It was.
So the specific tickers for firms with strong exposure to equities, fixed income, and institutional brokerage are MS for Morgan Stanley, GS for Goldman Sachs, and SCHW for Charles Schwab.
And these firms thrive, specifically because they are built to capture that constant flow of institutional repositioning we just talked about.
Exactly.
And what we have to remember here is that all this heightened trading volume, all this frantic portfolio rebalancing, it has to take place somewhere. The trades do not just happen in a void.
Right, they need an actual venue.
Yeah, when a pension fund buys or a hedge fund sells, those orders have to be routed to a physical or digital location to be matched. And this leads directly to our next group of winners, the exchange operators.
Now, people often call these exchange operators the toll booths of the financial markets, but honestly, I think that is a tired analogy. Toll booths imply a slow, mandatory crawl.
That is a fair point. What do you compare them to?
To me, these operators feel much more like a casino. The house truly does not care if the gambler, in this case, the institutional investor, bets on red or black.
Oh, I see where you're going with this.
Yeah, they do not care if the broader market goes up or down. The house just takes a small cut of every single chip placed on the table.
The casino analogy is actually incredibly accurate here. The backdrop of market volatility inherently means more hedging and more risk management. Mechanically, that equals more contracts traded.
Right, because if you want to protect your downside, you have to buy protection.
Exactly. Every time a fund wants to protect its portfolio against a sudden drop, they buy an options contract. That transaction happens on an exchange. The exchange collects a fee for the trade.
As simple as that.
But the casino dynamic goes even further than just the initial bet. There is also clearing volume. When you make a massive trade, there is always counterparty risk.
Right. Like, what if the person selling you the stock goes bankrupt before the trade actually settles 2 days later?
Exactly. The exchange acts as the clearinghouse. They step into the middle and guarantee the trade will settle. And for taking on that momentary risk, they charge a clearing fee.
Wow, so they are getting paid on multiple fronts. And beyond the trading and the clearing, they're also selling the actual data, right?
Oh, yeah.
It feels like they are charging the players just to look at the cards.
Precisely. I mean, the institutions executing these rapid trades need real-time data to make their split-second decisions. They cannot rely on delayed pricing.
Right, a 15-minute delay would ruin them.
Absolutely. So they pay premium subscription fees to the exchanges for continuous real-time beta feeds. The directional move of the market is completely irrelevant to the exchange. They profit from the sheer volume of traffic passing through their systems, the clearing guarantees, and the data subscriptions.
Okay, so let me give you the specific tickers for the market infrastructure operators benefiting from this backdrop. They are ICE for Intercontinental Exchange, CME for CME Group, and NDAQ for NASDAQ.
Those are the venues making it all happen.
Now, capital is finite, right? If a massive amount of money is flowing toward these trading, volatility-driven businesses and exchange operators, it is naturally rotating away from other areas.
Yeah, money moves to where the momentum and the guaranteed fees are strongest.
Which brings us to the financial stocks acting as relative losers in this specific environment. Let's look at who's being left behind.
Well, the first group of laggards here are the regional and traditional spread lenders. The core issue is that their entire business model is based on plain vanilla lending.
They don't have those massive trading floors.
Right. They do not have massive advisory divisions. They do not have bustling trading floors capturing bid-ask spreads. They essentially do two things. They take in deposits from customers, and they lend out that capital in the form of mortgages or business loans.
So they make their money on the spread between what they pay the depositor and what they charge the borrower.
Exactly.
But, I know a lot of listeners might hear that and think, wait a minute, interest rates have been relatively high recently. Shouldn't traditional banks be making a fortune charging higher rates on loans? Why are they actually struggling in this environment?
It is a great question, and it really comes down to funding costs. Yes, a bank can charge more for a new loan today. But remember, they made millions of loans 3 or 4 years ago at incredibly low rates.
Ah, like those 3% mortgages everyone locked in.
Exactly. Those loans are still on their books, barely generating any yield. Meanwhile, depositors are looking at the current market and demanding higher yields on their savings accounts.
Right, because if I can get 5% on a treasury bill, I am not leaving my money in a checking account making zero.
Exactly. If a regional bank wants to keep your deposit from leaving, they might have to pay you 4 or 5% interest. So they are paying out 5% to hold your money, but they were only collecting 3% on a mortgage they issued years ago.
Ouch. That is a negative spread.
Yeah, it squeezes their profit margins really tightly. Because they lack large capital markets divisions to offset these tight lending margins with trading fees, they just do not enjoy any upside from market volatility.
So the specific regional bank tickers in this category are KEY for KeyCorp, CFG for Citizens Financial Group, and ZION for Zions Bank Corporation.
And it doesn't stop with the regional banks.
No, it doesn't. Next, we have the credit-sensitive consumer lenders. When we examine Citi's earnings results, which again, we are using as our roadmap today, the numbers were driven completely by institutional strength.
Right, there was no upside surprise in consumer credit to speak of.
No, the retail side was effectively flat. The specific consumer lender tickers here are COF for Capital One Financial, ALLY for Ally Financial, and SYF for Synchrony Financial. These are firms heavily tied to auto loans, credit cards, and retail lending.
Which is a tough spot to be in right now.
But I want to push back on this premise just a bit. Are these regional and consumer lenders actually failing in absolute terms? Are their businesses truly deteriorating, or are they simply standing still while the large diversified banks sprint ahead?
That is a crucial distinction. It is largely about relative positioning, and it is entirely driven by a cautious macro environment.
What do you mean by that?
Well, during Citi's earnings call, their management made it a point to remain cautious about the broader economy ahead. They're not popping champagne over the consumer. In an unclear economic backdrop, investors actively prefer certainty.
Okay, that makes sense.
If you are an investor looking at a traditional consumer lender right now, you see potential risk. You worry about consumer credit quality. If the economy cools down, will people start defaulting on those auto loans and credit cards?
Right, that is a very real fear.
Exactly. So instead of sitting around waiting to see how the lending environment plays out, investors take their capital and allocate it to the diversified banks. They know the diversified banks are generating guaranteed massive fees right now from institutional trading. It is a rotation toward immediate, visible earnings.
And this preference for diversified earning streams actually extends even further down the line. It also pulls capital away from slower growth financial sectors. We are seeing insurance companies and asset managers experiencing relative underperformance in this exact same environment.
Yes, we are. And again, this is a relative performance call. It is not necessarily a direct negative headline about the core operations of these specific businesses.
Right, they aren't necessarily doing anything wrong.
Exactly. Capital is simply rotating into the broker bank complex because it offers immediate rewards, leaving the slower growth financials behind.
So the specific tickers for these asset managers are PFG for Principal Financial Group, BEN for Franklin Resources, and TROW for T. Rowe Price.
And this brings up the core concept of opportunity cost for you as an investor.
Yeah, absolutely. In the stock market, standing still when others are running often leads to rapid capital reallocation. Your money could be sitting in a perfectly steady asset management firm,
Right.
but if the diversified banks are out there posting their highest quarterly revenue in a decade, the opportunity cost of leaving your capital in the slower-moving stock becomes far too high. You are basically leaving money on the table.
That is the exact mechanism driving this rotation. Asset managers operate on a very different business model than a trading desk. Their revenue is largely based on fees taken directly from assets under management.
Which is often referred to as AUM.
Right, AUM. If an asset manager charges a 1% fee on a billion-dollar portfolio, they make $10 million. It is a very steady, reliable business model.
But it doesn't scale instantly with market chaos.
Exactly. It is a slower growth mechanism. If the broader market is volatile but generally trading sideways, the total value of those managed assets does not grow. Therefore, the fees do not grow.
Ah, I see.
An asset manager cannot immediately monetize a wildly volatile trading day the way a broker bank can. When institutional flow, rapid repositioning, and pure trading volume are the primary drivers of profit across Wall Street, asset managers simply struggle to keep pace with the broker bank complex. The capital naturally flows toward the immediate action.
So let us summarize the core takeaways for you based entirely on the data we have explored today. The best positioned financial firms right now are clearly those with massive scale, aggressive trading capability, institutional flow, and direct exposure to deal making.
The data supports that completely.
The outstanding results from Citi serve as a precise indicator of this environment. If this current trend holds, the large money center banks, the brokerages, and the exchange operators will continue to comfortably outpace traditional spread lenders and asset managers.
Yeah, capital is actively rewarding the specific earnings quality and the fee-generating power behind these large, diversified operations.
It really is.
But, as always, we have to look one step ahead.
Oh.
Consider what happens to these specific capital allocations if market volatility suddenly drops. What happens if the markets calm down, prices stabilize, and those high trading volumes completely dry up?
That is a fascinating question.
If the trading desks suddenly go quiet, which of these current laggards, like the steady asset managers or the traditional lenders, might suddenly look highly attractive to the market again? It is a constant rotation, and understanding the mechanics behind it allows you to see where the capital might move next.
That is something to really think about as we watch these sectors move. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.